Welcome to lesson number 3. In this video, I'm going to teach you how IBC works. Now in the previous video, Carl's explained to you what IBC is and what it can do for you. But in this video, I'm going to show you how IBC actually works. Now in order to do that, I need to explain what a whole life policy is and how it works, because a whole life policy is the platform upon which the process of IBC is implemented. In this lesson, we're not going to get too technical, but I am going to give you enough information to know how IBC works. Some of the topics we'll cover are the difference between a term policy and a whole life policy, how to actually read a life insurance policy illustration, what the cash surrender value is, and what's really going on when you take out a policy loan. So let's jump right into it. What's the difference between a term policy and a whole life policy?
A term life insurance policy, as the name suggests, means that it's a life insurance policy that's in force only for a particular term. So for example, let's say you're age 30, you could take out a 5-year term life insurance policy. So the way that thing is structured contractually, so long as you keep making your premium payments on time, the life insurance company keeps that policy in force up through age 35. After that point, the 5-year term policy expires, and you either have to go apply for a new policy, and if your health status has changed in the interim, it might be harder or impossible for you to get one, or you can choose to go without life insurance from that point forward. Now, there are 5-year, 10-year, 15, 20, 25, 30-year term policies. Those are all pretty standard. So, for example, if you were 30 years old and you took out a 20-year term policy, what does that mean? It means you would have life insurance coverage, again, so long as you kept making your premium payments, up through age 50, at which point that 20-year policy would expire. So that's what a term policy is, and that's probably what most people think of when they're thinking of life insurance. But another class of policies is what's called permanent life insurance. And as that name suggests, a permanent life insurance policy is in force permanently. Again, so long as you keep up your end of the bargain and make the premium payments as the contract requires. Now, within the class of permanent life insurance policies, there's different varieties. The one that Nelson Nash thought you should do if you want to practice the infinite banking concept, or IBC, and this is very important, is a whole life policy. Okay, so to be clear, there's different types of permanent life insurance policies. Just to give you an idea, for example, a different kind would be what's called universal life, or a UL policy. Okay, so to be clear though, what Nelson Nash thought you should use if you were going to implement IBC was a whole life policy. So to repeat, a term life insurance policy is only in force for a particular term. Even if you as the customer do everything you're supposed to do on your end and keep up the premium payments, even so at the end of that term, the life insurance company has the legal ability just to walk away from you. They don't owe you coverage from that point forward. You'd have to reapply for a new policy. In contrast, again, just to repeat, a whole life policy, it's a certain type of permanent policy, and as the name suggests, a whole life policy is in force for your whole life. Now, just to mention a quirk of how these things are designed, what will happen is actually they have a built-in completion point. So, for example, it's pretty typical now in the U.S. that these policies are designed to fulfill or mature at age 121. So, for those people who happen to be in great health, and if they have a whole life policy in force, and they just so happen to be able to live to be 121, at that point, the policy matures, it completes, and the life insurance company pays over what's called the death benefit, even though the person hasn't died yet. Okay, so that's just a quirk of how these things are designed so that the actuaries can have a finite endpoint and then work backwards. Now, another significant difference that's very relevant for IBC between a term policy and a whole life policy is that the whole life policy, as it ages, builds up what's called the cash surrender value. Now, the cash surrender value, let me first give it a sort of analogy just to get you thinking about it, and then we'll talk more specifically about what it is and how it works. So the analogy that I heard that I think is a good one for a beginner is think of it in terms of like renting an apartment versus buying a home with a mortgage. So if you're renting an apartment, there's nothing wrong with that. It's not that you're getting ripped off. It makes economic sense. You are the tenant. And every month, let's say you make your rental payment to the landlord. And what do you get in exchange for that? You get a flow of shelter services. All right, you're kept out of the rain and the cold. Now, after your lease expires, let's say it's a 3-year lease. So you make your monthly rental payments, and as long as you do that, the landlord doesn't kick you out. But after 3 years, even if you've never missed a payment, the landlord can say, I want you out. Your contract doesn't entitle you to keep living here indefinitely. It's just a term rental policy, if you will. And along the way, you haven't been building up equity in any sense in the apartment. All you're doing with those monthly rental payments is buying on the spot, as it were, the flow of shelter services. Again, nothing wrong with that, but that's just the way it is. In contrast, if you get a mortgage from a bank and buy a house, then every month you're making your mortgage payment. And as you probably know, there's a sense in which you're building equity in the property as well, because the lien of the bank against the property keeps shrinking. And so more and more of that market value of the house is yours free and clear. That's one way to think about it. Okay, so there, when you're buying the house with the mortgage, your monthly payments, in a sense, are doing two things. On the one hand, it's entitling you to that flow of rental services, right? Shelter, the ability to just physically live in that house and stay out of the elements. So that's partly what you're getting in exchange for making that payment every month. But beyond that, you're also building up an asset. So that's a useful way to start thinking about the difference between a term policy when it comes to life insurance and a whole life policy. Because again, in the whole life policy, the cash value rises over time. Whereas with the term policy, again, what you're getting in exchange for those premium payments is the coverage. If you happen to get hit by a bus while that term policy is in force, then your beneficiary that you named is going to get the death benefit. And that condition is in force throughout the life of the term policy so long as you keep up with your premium payments. And that's a good thing to have, right? There's nothing wrong with that. But you're not building up a financial asset in addition with those premium payments. So again, in contrast to that, with a whole life policy, there's what's called the cash surrender value. And as the policy ages, that cash value rises over time. Now let's talk a little bit about what is the cash surrender value. Okay, so a more technical, formal definition runs along the line saying it's the present discounted value of the actuarially expected future death benefit payment minus the flow of remaining premium payments that you, the customer, still have to make on that thing. All right, so that's a mouthful, and if that's above your head, don't worry about it. I just wanted to say it, though, for the overachievers out there in the audience. And so that's, if you understand what those terms mean, that's one way of understanding how it is that as time passes, as you keep making premium payments, for example, then you, the customer, owe less on that policy going forward. And so now more and more of what's remaining is just that looming death benefit that the life insurance company owes you. And so that's one way of thinking about why the cash surrender value would rise. Now, more intuitively, what's going on? Think of it this way. The life insurance company on term policies knows that typically it's not going to have to pay out on those things, right? The vast majority of term policies are going to expire where the customer is still alive at the end of it. And so the life insurance company was just collecting the premium payments all along and didn't actually have to pay out a death benefit. In contrast, with a whole life policy, so long as the customer keeps that policy in force and doesn't let it lapse, the life insurance company knows necessarily they are going to pay on that policy because the person's going to die eventually, or in the rare case, the person might live to be age 121, let's say, at which point the policy matures, and then the life insurance company has to go ahead and hand over what was called the death benefit. Okay, so with a whole life policy, the way to think about it is the life insurance company is collecting those premium payments and they have to go put them to work. They have to invest them in financial assets because there's a sense in which you're like a ticking time bomb from the life insurance company's point of view. If you've got an in-force whole life policy, then the life insurance company knows at some point, sooner or later, they're going to have to pay out on that policy to you. Because again, you're either going to die or you're going to live to complete the policy. And so over time, the assets that the life insurance company has been investing sort of earmarked to your policy or on behalf of or backing up, if you will, your policy are going to grow, right? Because they keep getting premium payments from you. They're going out and buying assets with them and managing this big portfolio of assets, sort of backing up your policy and all the other policies that they've issued. And so the market value of those things rises over time. Now, the older you get, what is that going to do to that actuarial liability on the books of the insurance company, right? Again, if they've got a whole life policy out there in force on you, the older you get, the more likely it is that you're going to die. And so let's say the death benefit's $1 million. If you're a 25-year-old in great health, the life insurance company is not viewing that thing as if they owe you $1 million, right? It's not the same as if they had issued a bond and now the bondholder comes back to him and says, okay, where's my $1 million, right? It's not the same type of liability, but it is a liability, all right? Now, in contrast, suppose you're 95 years old and the life insurance company has issued a policy on your behalf and they owe $1 million when you die. You can see how the liability from their point of view, as they're crunching the numbers, on you, a 95-year-old, is much greater than on a healthy 25-year-old, right? Because again, if they ask their actuaries, what's the likelihood or how soon should we expect this person to die, at which point we owe somebody $1 million, whoever the named beneficiary is, the actuaries are going to say, whoa, this person's 95. That's pretty close. So we need to have enough assets set aside right now to be able to pay that off, right? And so the assets they would have to have set aside at that point are going to be a lot closer to $1 million than they would need to be for the healthy 25-year-old. Okay, so these are just intuitive ways to think about why it is that the cash surrender value rises, because contractually, what the cash surrender value is, as the name suggests, the life insurance company, if you want, you can surrender the policy and they will give you that spot payment. And so that's, in a sense, a way to think about it, that it's how much would the life insurance company pay you, the policyholder, to walk away from your policy, to stop making the premium payments, just walk away. The life insurance company, as that policy ages, would be willing to pay you more and more for that. Because again, the older you get for a given policy, the bigger the financial liability in a statistical sense it is to the life insurance company, because they know you're that much closer to death. And also, depending on how the contract is structured, if you have fewer premium payments left in the life of that policy, that's another reason that financially it's more of a liability to them, right? Because at the point at which you still have years and years worth of premium payments, from their point of view, that's going to offset the blow, or it's going to mitigate the hit to them when they got to pay you the death benefit, is because they know, oh, so long as this person stays alive, we're getting this flow of premium payments. So that helps cushion the blow. In contrast, if it's a policy, let's say, that's paid up after 65, right? There's policies like that where after age 65, you could be all paid up. With that type of policy, once you get past that final premium payment and you're in the clear as far as you, the policyholder, then the life insurance company knows it's just a matter of time of managing those assets without any more premium payments. And at some point when you die, they have to pay the death benefit. Okay, so those are just trying to give you intuitive ways of thinking about what is the cash surrender value and why does it rise over time. So let's review for a moment. A whole life policy is a very flexible life insurance policy. The premium structure is actually pretty variable. You can set it up where, for example, you just pay a fixed premium every year of the policy or every month up until you die or you reach age 121. Another type of design might have you paying premium payments up until a certain age. For example, the policy might be described as paid up at 65. So as that name suggests, once you reach age 65, contractually, you don't owe premium payments anymore. So it's still in force. They still are going to owe you the death benefit whenever you die, even though you're not making premium payments in that type of a structure past age 65. Another example would be something called perhaps a 10 pay. So here, you take the policy out, let's say you're age 25, and then every year you make a fixed premium payment, and after the 10th year, you don't owe any more money contractually, right? So it's just built, it's designed that you make 10 premium payments, and that would be called a 10 pay. Okay, so these are all different types of premium structures for a whole life policy. So there's a lot of varieties even within the class of whole life policies. Now here I should mention, I'm not talking about what's good or bad with respect to implementing IBC. I'm trying to explain to you how these things work and the different varieties that are possible, the different flavors, if you will. Now, continuing our review, the cash surrender value on a whole life policy, what it is contractually, the life insurance company says, at any point in this policy, you have the option to just stop, to walk away. So if you still owed premium payments, for example, you don't owe them anymore. However, the life insurance coverage also dissolves, but the life insurance company gives you a going away present, right? It's a severance package, if you will. If you're willing to just dissolve the policy and walk away, they give you a spot payment that's less, of course, than the death benefit, but that has been growing over time. And again, why does the life insurance company have the incentive to do that? Well, because by you dissolving or surrendering the policy, you're removing that ticking time bomb from their liability, right? That the older you get with a policy that's in force, the closer you get to dying or reaching age 121, let's say, and them having to pay out the death benefit. So by you walking away, they would gladly give you a smaller amount to make it worth your while. And then how do they have the ability to do that? Well, because if they've been wise stewards, they've been investing your premium payments all along to sort of back up the policy that you have. Now, I should be crystal clear here. The cash surrender value, that schedule is part of the contract. Okay, so there are guaranteed cash values at various points along the policy's life. So when you take out a policy and sign the dotted line in the beginning, you know that, if I were to surrender this policy, let's say 18 years in, you know what the guaranteed cash value is going to be at that point. Right? So the life insurance company is on the hook contractually. They're guaranteeing you a rising schedule of cash surrender payments as the policy matures. Now, there's regulations affecting that, right? So the state regulators have rules in place for what the policy has to look like and how the cash surrender values have to rise over time. But my point is, it is contractually built into the policy. It's not guesswork. It's not that you get the policy and then learn, is there going to be cash surrender value or not in year 18? They have minimums that the policy will perform at least that well.